Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
We see clients come in every day and they don't have a plan in place. They don't know their risk, they don't know their fees, they don't know where their income's coming from, and more importantly, they worry about running out of income. And then they want to also understand, can they leave money to their children? Without putting that in writing so that somebody becomes accountable for that and the client actually understands it, it's like going through your entire retirement with hope and luck.
Well, in reality, that's what Jim and I believe, that the market will always come back. And you can have that mentality if you're young. If you're 20, 30, and 40, you can always ride it out. We think the worst 3 words any investor can ever be told is to write it out.
But once a client understands their money and what it's supposed to do for them in the future and where their income's coming from and that it's probably not ever going to run out, they feel really, really good about their money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hey, thanks for tuning in this week.
We got 30 minutes of great information just for you.
Don't go anywhere. The show starts right now.
Jim, I'm so excited about this week's segment of Fix Your Money. It gives us a chance to look at a hypothetical case study that would be really close to what a typical client we work with looks like. So we can look at more details than we typically do in the other sections of the show. And we know it might seem complicated, but we're going to simplify it and make sure people understand this is how a plan could look like. Because the most important thing we always talk about is what? Someone has a what?
Having a comprehensive plan.
Got to have a comprehensive plan. So let's look at a hypothetical lady named Fran. She's 75, and let's assume her husband passed away a year ago. So now she has to take care of her money all by herself, which is a whole new dilemma.
Right.
She's a realtor in the San Francisco Bay Area. She doesn't want to have to work anymore down there because she has to drive down all the time. Let's assume she has no pensions. She has about $1.6 million of assets in her portfolio and about $100,000 in the bank. And of course, she's worried about everything, being alone, having to take care of everything. She's worried about that her portfolio is 70% in bonds right now. She's taking care of the money by herself. She needs to generate about $100,000 a year of total income to be able to pay for everything. And she thinks she could be taking a significant amount of risk in their stocks and the bonds because the portfolio does have a lot of volatility as she watches their statement values. She's worried about her money in general, but more importantly, she's worried about the money running out. She thinks she may have to sell her house at some point just to get by. And then because of where she's at now, she's worried she's not going to be able to leave any money to her 4 kids. And she's had a broker for 25 years, and her husband used to deal with him. She never really dealt with him. And he's told her that her assets are positioned perfectly and properly based on how her husband used to invest the money. She's never had a written plan. She wants one.
Yep.
So at this point, then, what do we do?
Well, the first thing we do is we have to do a risk analysis because you mentioned she was concerned about her money and the volatility in the market. So we actually use third-party resources in order to do these risk analysis on behalf of our client. We see this a lot, Dan, in our firm. We have a lot of single women that come to us because their husbands have passed. They're in the same type of dilemma. And now they're on their own. They have to manage their assets all by themselves. If their husband had been participating in this or been taking on this role really in a big way in a big way, these particular women are very, very concerned, and it can same thing happen with a man. So in this example, after we did a risk analysis, we determined she had a 21.2% risk factor in her portfolio, which means if we have another financial crisis, like we did in '08, she'll lose about 21% of her assets.
When you think about it, she had 70% of the assets in bonds in this example, only 30% in stocks or stock mutual funds, and still having that type of potential risk. Do you think there's any way possible anyone like her out there would think they have that much risk if they have a 70% bond, 30% stock portfolio?
Not at all. As a matter of fact, this is a lot less risk than a lot of clients have because, as you mentioned, she was really overweighted with bonds inside of her portfolio. And if this happened, she would lose about $337,000 of her hard-earned assets, which means she needs about a 27% recovery gain just to get back to even if that happens.
So what's the chance now, if she has a 70% bond portfolio, 30% stock portfolio, if she lost 21%, what's the chance of quickly making 26.9% off of that type of ultra-conservative, supposedly, portfolio?
Dan, we're in some of the lowest interest rates in American history, and to earn 27% return in order to get back to even is going to be very, very difficult in this example. So after we reconstructed the portfolio and remodeled all the assets, we reduced our risk factor to a projected 4.1%. So rather than losing 21.2%, she was projected to lose more, around 4%. Her loss would be about $65,000 versus $337,000. She still has risk in her portfolio. We can't get out of that risk factor if you own securities, but we were trying to potentially lower that risk to make it more acceptable with what she wanted to plan with, and we only needed about a 4% rate of return in this example to try to get her back to even.
So basically, one of the things we talk about is dialing your risk level in.
Yep.
And people don't understand they can actually create how much risk they're actually willing to take themselves in their own portfolio. They don't have to listen to their advisor to say, oh, don't worry, everything's going to be okay. Well, for her, a 21.2% loss is not okay. Losing $337,000 is not okay. She felt comfortable if we could get the risk, just like most people out there would probably feel comfortable, if we can get that risk down to about 5% or less. Because 5% or less seems reasonable. We still don't want any loss at all, but 5% seems reasonable if it's going to allow us to try to hit some of our goals.
That's right.
Well, after we did the risk analysis, then for anybody, we want to then create a comprehensive retirement income analysis. And it's going to seem complicated, but it's not. We're going to put everything about your money going forward on one page. Think about it. If you could see how you're going to succeed financially on one page, it makes it easy now. You can actually start understanding your money. We're going to show what sources of income you have, whether it's Social Security, whether we use stop-loss technology in the stock market, whether it's guaranteed income from annuity companies, whether you have money in the bank. We're going to show all those on one page. And then for 30 years, we're going to project out where you're going to get your income sources from, and it's going to show how much income you're going to have. So in 2018, if you go across that red oval, you're going to see she had her $100,000 of income that she wanted on a gross basis, which is probably going to provide her about $7,500 a month of net income. So she makes $100,000 of gross income, giving her probably about $7,500 a month net after taxes. And she's not going to have to worry about running out of money for as long as she lives. So how would that now fit? How does that make someone feel? The people watching right now, if they had this one-page simple sheet, how would they feel?
Well, they're comfortable. They understand their money. They know the potential risks they have in their portfolio. And of course, we do a fee analysis and we bring in other elements in the planning process. But once a client understands their money and what it's supposed to do for them in the future and where their income's coming from and that it's probably not ever going to run out, they feel really, really good about their money.
Definitely. So those of you out there, if you like what you're seeing and you say, hey, I would really like to see everything about my money on one page, feel free, just give us a call. We'll be glad to meet with you and see if we can help you.
Yeah, and remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, I'm Dan Ahmed. My partner Jim Files and I are co-founders of Peak Financial Freedom Group. We are proud sponsors of the show. As investment advisor representatives of our own RIA, we are legally bound by a fiduciary duty to our advisory clients. Specifically, we owe our advisory clients an affirmative duty of utmost good faith, requiring us to provide full disclosure of all material facts and obligating us to employ reasonable care to avoid anything misleading. We design customized written retirement income plans for retirees and soon-to-be retirees. If you've saved a lot of money for retirement and don't want to lose it, don't want it to run out, and don't want to make a mistake with it, stay tuned. You're going to love the show. We want to help you protect your assets against large stock market losses, earn competitive returns without taking excessive risk, and create dependable monthly income that will last for as long as you live. Our goal is to help you stop worrying about your money so much by building you a customized written retirement income plan. We put everything in writing. And here's the best news. We will not charge you for your plan. You will never feel any obligation or pressure to work with us. It's always your choice. But if you do decide to become our client and you're looking for some growth without taking excessive risk, we get paid advisory fees on the money we invest for you. If on some of your funds you're looking for protection against stock market losses and need dependable lifetime income, and we use an annuity as part of your plan, we are paid commissions. That's why we don't have to charge you additional planning fees to create your customized, comprehensive written retirement income plan. Before you invest any money with us, we will tell you all the fees you will pay in writing. We believe in transparency. And after we build your plan, you won't worry about your money so much. Sit back and enjoy the show. Thanks for joining us.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, and welcome to this week's Retirement Roundtable. Gentlemen, today we're talking about half-truths in the retirement world, and my goodness, there's probably a bunch of those. But I'm going to start with this one, Dan. It's only a paper loss. Just stick around. The stock market may have gone down, but it always comes back, right? And it always goes higher.
Well, in reality, that's what Jim and I believe, that the market will always come back. And you can have that mentality if you're young. If you're 20, 30, and 40, you can always ride it out. We think the worst 3 words any investor can ever be told is to ride it out. We never will tell our clients to ride out the stock market because they don't have time. They're not saving. They need to use their assets for income. And it is time to now use their dollars and protect them because they never want to lose what they've saved so far. So you can't take a ride it out mentality in today's volatile marketplace.
So let's talk about this for a second, Jim, because I know you guys are not about holding, right? You got to manage this money. This money, tell me how you do it at peak.
Well, you got to remember the type of clients we're dealing with, number one. We're dealing with people that are very soon to be retired or retired. They don't have recovery time. They're making contributions to the retirement plans. They're going to use their assets for income for the rest of their lives. They can't write a market down for 5, 6, 7, 8, 9 years. And there's no way for us to determine how long that market will be sliding on the bottom and when it will come back. And if you're draining your assets in the form of income, you may possibly run out of money. And that's a scary thought for every single consumer listening to this show right now. They're afraid they're going to run out of money. So what do they do, Dan, when they're afraid to run out of money?
Well, they don't use their money. And the reason they save the money, Mark, in the first place was to use it for income that will last for as long as they live. Now think about it. These people are 60, 65, and 70, and they're not actually using their money, which is going to create regrets. And they're planning to take that trip to Italy. They're planning to help their grandkids with college, and now they can't because they're afraid to use the money. So you have to put a plan together that will make the fear of a big loss reduced or eliminated, and then you had to put a plan together that's going to create dependable monthly income that's going to last for as long as they live, because that would then eliminate their fears of the money running out, which is their biggest fear.
You know, Dan, I've had the opportunity to see you speak live, and you talk about that people are today too much at risk in the market. And one of the things you talk about was that they're sort of investing as if they were a retiree in the 80s and 90s, where everything went up, we were all so joyful, right? But that sort of thinking today can be a little dangerous, right?
Well, you and I have talked about it, and Jim's talked about this, that's kind of old school thinking. It just doesn't work anymore. When you say, I'm going to ride out every stock market loss and the stock market's going to provide me everything I need, right now, if you look at what's happened since 2000, just go through 2018, the S&P 500 itself has only gone up by 2.85% per year compounded before you deduct for fees. So think about all the risk and how much you worried about your money during this 19-year time period. Was it worth a 2.85% rate of return, then minus your fees? What if you paid 3% in fees? How much did you really make?
You know, Dan, it's really shocking because people really don't understand this. We have written many, many books. We deliver lots of content to the industry, and they really don't understand what you just said, Dan, because they really think that they're always going to get a 10% rate of return on the stock market, right? They're not. I mean, if you look at history and you take the time period that you just talked about, Dan, that 19-year period, 2.85% compounded if you're good enough to get S&P returns, which most people aren't, and that's before you paid taxes, paid fees, or took any money out of your portfolio.
Well, think about the other analysis we did, and that goes back to 1996, and it takes every 15-year time period in the S&P 500 index since 1996 through 2018, and there's 9 of them. Yep. The average rate of return per year of the S&P 500 index increase was just slightly over 4%, then minus your fees. So you took all this risk, 2 potential 50% losses for those little potential rates of return. What has it netted you? Not much.
As fiduciaries, I know that you still believe that there is a place for the stock market with most of your clients, maybe not all of them. So how do we determine that?
Well, first of all, it starts with the objectives the client's trying to achieve in retirement. Those objectives will determine what asset classes we're going to use in their portfolio. How much money is going to be allocated to the stock market? How much money is going to be allocated to cash? How much money is going to be allocated to maybe guaranteed products that provide income for the rest of their life? It all depends on what the client's trying to achieve with their money, and that will determine how we're going to build a plan for them.
We always say, Jim, that basically people come in and they ask us, how should I invest my money? And that's the wrong question. Right. The question isn't how should I invest my money? The question is, what do you want your money to do for you? And then we build a plan, and the plan actually dictates how you should allocate and invest your money. Think about it. What if now your first goal is to determine what you want from your money? Yeah. Then you build a plan that will now allow you to obtain those goals. Then you only invest your money based on the plan that says invest it this way, and you have a high probability all your financial goals are going to come true.
See, and I love that. And the people that are listening at home right now, they need to hear that one more time. How you invest your money at peak is about what your goals are. And the goals are going to dictate the plan. Is that a fair statement?
That's exactly right. And it's not just dumping all your money in the stock market, because that's where you've been. You got to look at your age. You have to look at what you're trying to achieve with that money. Is it for income? Is it for growth? Is it for legacy? Is it to fight off inflation? Is it for long-term care? You have to consider all of those elements in order to put a proper plan together so it's comprehensive and entails all of that information so that you'll live a comfortable retirement and you won't worry the rest of your life.
Yeah, for example, if you looked at what we use in our 3-bucket approach, just a simple approach on how people can invest their money. One is we need to have money in the bank. And advisors don't tell their clients to put money in the bank because the advisors don't get paid to do so. But we like clients to have a significant amount of money in the bank when they're retired. It's liquid, there's no fees, and it's safe. Second is we want to make sure we create as much dependable income that they can get for as long as they live so they can now spend it. That's what it's for. And third, we do want money in the stock market as long as we can put stop losses or some other type of risk mitigation on the stock market, because when we look at their whole portfolio, we want to significantly decrease overall risk in their portfolio if we have a major market crash.
Dan, Jim, thanks so much. If you want more information about this topic, hey, give us a call in the office right now. We'd love to start a conversation, or go to the website. And don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Are you worried about taking too much risk, paying high fees, creating dependable monthly income, your money running out? You can stop worrying about your money by meeting with a full-service retirement planning firm, not just someone who invests your money. Call right now to receive your free, no-obligation Peak Retirement Navigator review that includes a total fee audit, a risk stress test showing your potential losses, a retirement income analysis showing how long your money will last, and the steps to create a customized written retirement income plan. Our clients typically have between $1 million to $20 million of assets, but if you've saved at least $500,000 for retirement, we will meet with you free of charge to see if we can possibly help. You'll get free educational copies of Mama's Secret Recipe for Retirement Success we co-wrote with Jack Canfield from Chicken Soup for the Soul, and our beautiful, inspiring 100 Shades of Financial Freedom. So don't wait. Call the phone number on your screen right now. You have nothing to lose, there's no pressure, there's no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's episode of Peak University. Today we're going to talk about how do you want your money to actually act? Very important topic. We actually covered this in detail, Jim, in our latest best-selling book with Jack Canfield. He's the guy who wrote Chicken Soup for the Soul that sold over 500 million copies worldwide. The new book is titled Mama's Secret Recipe for Retirement Success, and we teach people that you actually can make your money act the way you want. It's not the old school way of saying, put your money in there, don't watch it, write it out. It's you can actually make your money act any way you want.
That's right. And there are two myths, Dan. Number one, writing out the market, you'll be fine. And number two, you're going to get a high rate of return of 10% if you stay in the stock market. And we hear this often from people coming in that are seeking second opinions from our firm. Those two myths are not accurate.
So you're saying those are falsities?
Well, they're falsities unless you live 200 years in retirement, right? And you have enough time to do this kind of stuff. But if you're in retirement or close to retirement, you have to be really careful. And you better not be relying on those two things to get you through retirement.
Well, think about, have you been told these things before? Have you been told it's the best thing ever that you should always write out the market? If the market goes down, hang in there, take the loss, it'll come back. And have you also been told, hang in there because you're going to get a 10% or higher rate of return? And we think there's a high probability you were told both of those things many, many, many times. So Jim, let's debunk those myths and show what's really happened in the stock market from the year 2000 through the year 2018. That's a time period of 19 years. This is a graph of the S&P 500 index and what has happened in that time period. Go ahead and start explaining that.
Well, let's assume back in 2000, you invested in the S&P 500 and it was at almost 1,500. Then we had 3 consecutive years where the market crashed. That was the technology bust or the dot-com bust, where the market went down about 50%. So you're at the bottom right here. Then it took almost 5 years for the market to come back up. So you're back up finally in 2007. And if you're lucky, if you paid no fees, paid no taxes, and took no money out of your portfolio, you might be back to even. Then what happens, Dan?
Well, think about it. When you're in this time period right here, As soon as you start losing money, you go to your broker, you've lost 10% of that 50%, and you go to your broker and you already are freaking out. You're worried, you're scared, and you tell your broker, I'm worried of these losses. And the broker says, don't worry, it's going to be okay. Hang in there, ride it out. Everything's going to work out okay. You're going to get these great rates of return if you ride it out, if you hang in there. So then you go in the second year, you've lost another 20%. Now you're really freaked out, and you tell your broker again, I'm worried about my money. I don't want to take this type of loss or risk. And he says again, don't worry, hang in there, ride it out. And now you're down at 50% of a loss after the next year by taking that advice. Finally, at the end of 3 years, it starts going back up. And it climbs back up to 100%, and you finally are back to even maybe by 2007. And at that point, think about how happy you were at that moment. You were overjoyed. You're so happy. You're relieved. But what does it mean? You're relieved that you made 0%.
Right.
0% for that 7 to 8 year time period. And should you be relieved and happy to make 0%?
No, not at all. Remember, you're taking 100% risk in this example if you're in the stock market. And it's not that we don't believe in the stock market. We're a registered investment advisor. We do believe in the stock market for a portion of your money. But you do have to understand the risk, and you have to understand how to put risk mitigation measures in place to hope derail some of those losses.
Yeah, because we don't want you to be naked in the market. As you asked what happened before then finally you recovered. The market went down another 50% in the 2008 financial crisis. You needed 100% gain just to get back up to even again. Now for 13 years, if you started at 1469 in the stock market in 2000 and you end at 1469 in the stock market in January 2013, 13 years later, what's happened to your money?
You made no money. And people look at that, well, that's not true. It is true. That's mathematically perfect. That's exactly what happened if you had your money in the S&P 500 or an S&P type of fund during that period of time. And this is presuming you paid no fees, which is almost impossible.
So if you wrote it out like you were told, you would have then ended up way up here at 2506 in the market, December 31st, 2018. But the problem is that calculates out to an average compounded increase per year of 2.85%. We're going to say it again. You would have earned 2.85% per year for 19 years in the S&P 500 index if you would have wrote it out. Now, during this time period, it looks like you made this huge gain, but you didn't. 2.85% was the average increase. A lot of you right now are probably thinking, oh, Dan and Jim, that can't be right because my account grew substantially during this time period when I was working. Well, your account might have increased in value, but it didn't increase in value by a huge rate of return. Right. It couldn't have. Why did it increase in value?
Because most people watching right now were working during that period of time and they were making contributions to their own retirement plan. Your own money made your account value go up more likely than your rate of return. Because this is assuming you're able to get S&P 500 returns, and most people aren't. The S&P 500 is a peer index. It's really difficult to do this type of return over a long period of time.
So what if someone was saving $20,000 a year for 19 years during this time period?
Right.
Then how much should their account gone up just by adding those 20 years for 19 years?
Well, they would have about $400,000, right, Dan?
Exactly.
20-year
so the account would have grown by that amount, but they probably didn't earn much more than that.
That's right.
So if you have any questions about what we talked about today, feel free to call the office or go to our website. We got a lot more information like this for you right there.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Do you have an extra plan, or do you just receive statements from where your money is invested? Too few retirees and pre-retirees don't have a plan and are not prepared for retirement. A great way to get a clear, written retirement plan is to meet with a full-service retirement planning firm, not just someone who invests your money. If a clear, written retirement plan is something you want, be one of the first 5 callers right now and you'll receive our Peak Retirement Navigator review. Here's what you'll receive from your Peak Retirement Navigator. Number 1, a fee audit exposing your direct and hidden fees inside your portfolio. Number 2, a risk report showing you how much you could lose in a market decline. Number 3, a risk analysis to protect your investment from large stock market losses. And number 4, an income plan showing you how much income you will need in retirement. So don't wait. Call the phone number on the screen right now for your no-cost, no-obligation Peak Retirement Navigator review, which includes your Retirement Survival Toolkit. You have nothing to lose, there is no pressure, there is no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hi, and welcome to this week's Is Your Retirement in Jeopardy? Gentlemen, are we ready?
Yes. We're ready.
Dan, my first one is for you. One of the most highly regarded and respected designations in the financial industry, with requirements to meet education, examination, experience, and ethics standards, including adhering to the Board Code of Ethics and Professional Responsibility and the Financial Planning Practice Standards.
What is a certified financial planner? And you know what? It's amazing. I'm one of those. I'm a certified financial planner. There's not that many across the nation because it takes a lot of work, takes a lot of classes, testing, continuing education, and you have to adhere to all these rules and treat your clients at the highest level. It's very important to understand that when you're working with a firm, you want to make sure there is a certified financial planner as part of that planning team, because then I feel you're going to get the best plan.
Jim? Someone sells you a financial product or manages your assets and does not give you a written plan.
What is unacceptable behavior?
That is correct.
Thank you, thank you. And we see that all the time, obviously, right? We're kidding about this kind of stuff, but we see clients come in every day and they don't have a plan in place. They don't know their risk, they don't know their fees, they don't know where their income's coming from, and more importantly, they worry about running out of income. And then they want to also understand, can they leave money to their children? Without putting that in writing so that somebody becomes accountable for that and the client actually understands it, it's like going through your entire retirement with hope and luck.
Dan, the color chart you see in your statements that have a lot of pretty colors is made up of a bunch of mutual funds, is supposed to be diversified, claim to not have that much risk, holds that mutual funds are safer than stocks, and claims you are only paying 1% in total fees.
What is a beautiful pie chart portfolio?
Correct.
And many people watching right now, that's what they have. The only thing they understand about their money is every month or every quarter, or when they look on the internet, they have this beautiful pie chart. And it's beautiful, has all these wonderful colors. They might have 50 different funds, and all they can think about is why they own 50 funds is to be diversified. And it makes this beautiful pie chart portfolio. The problem is that portfolio, if made up of mutual funds, it could still have a lot of risk. They might have 30 or 40 or 50% risk the next time we have a market crash. They could be paying 3% or more in total fees. They can't really take a high level of income off of that's going to be guaranteed to last for as long as they live. So it's really not beautiful in reality, but it does look really pretty on your paper.
Thanks, guys. Hey, is your retirement in jeopardy? Maybe it's time to pick up the phone and give us a call in the office, or go to our website. And don't go anywhere. We'll be right back.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Are you worried about taking too much risk, paying high fees, creating dependable monthly income, your money running out? You can stop worrying about your money by meeting with a full-service retirement planning firm, not just someone who invests your money. Call right now to receive your free, no-obligation Peak Retirement Navigator review that includes a total fee audit, a risk stress test showing your potential losses, a retirement income analysis showing how long your money will last, and the steps to create a customized written retirement income plan. Our clients typically have between $1 million to $20 million of assets, but if you've saved at least $500,000 for retirement, we will meet with you free of charge to see if we can possibly help. You'll get free educational copies of Mama's Secret Recipe for Retirement Success we co-wrote with Jack Canfield from Chicken Soup for the Soul, and our beautiful, inspiring 100 Shades of Financial Freedom. So don't wait. Call the phone number on your screen right now. You have nothing to lose, there's no pressure, there's no risk, and it's free. And remember, at Peak Financial Freedom Group, we fix your money.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Hey guys, great show this week. Thanks so much for tuning in.
If you have any questions or need any help at all, feel free. Give us a call at our office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.